Okay, I think it works. So now, adjusting entries. We covered the theoretical aspect. Can someone remind us what are the three counter principles that justify and require making adjusting entries? Why we should do them? Adjusting means rectifying something that if we don't rectify it, it will be wrong. It will not be appropriate, right? So, why we do the adjustment? There are three counting principles that require that there was adjustment. First of all, okay, so justification of adjustment entries to start with. This only happens here in class. I don't know what is wrong with the in class. So go ahead. What are the three principles?
Shows the periodicity.
Periodicity.
Yeah.
The fact that the line of an entity is divided into independent periods. And when we say independent period, the period means that we have to make sure when we prepare an income statement that all the revenues, all the earned revenues are recognized and all the expenses are considered also. That is the first one. And then the second?
The second one is revenue recognition.
Revenue recognition principles, which means you recognize a revenue as a revenue, not once you get the money, not once the invoice is issued, but once what?
Where it's delivered or the service.
Once the revenue is earned, once the goods are delivered, if it is sale of goods, the service are rendered if it is about sale of service. And third, the matching principle, which means what? Expenses have to be recognized during the period, same period where the revenue that contributed to those expenses have been recognized. So look at your principle 2, when that specific revenue should be recognized, and any expense that contributed to that revenue has to be recognized on the same period. Okay, so let's practice this. For example, I have practice number 1. We have this is a trial balance, unadjusted trial balance for a company on December 31st. And we have the items, and then we have a list of situations that require adjusted entries. Okay, so let's start Let's start with the first one. They say, as on December 31st, the wage that had been paid in advance to the salespeople have been earned. Okay? So the first question here. We are talking about employees, okay? Salespeople. And it says that 80% of the wage that had been paid in advance. So we should have on our trial balance something which says advance to employees. Advances to employees. So it is about this, the $200,000 advance to employees. Okay. How did I recognize this? They say there are some payments that are made in advance. For sure, these payments should be at the trial balance. No way. They have to be there. And if I look at my trial balance, the most appropriate one is this, advance to employees. There have been $2,000 paid in advance to employees, okay? Now, they say, what does it mean advance? It's they got the money before they do the job, right? That is an advance. If if you pay in advance, you mean that you get the service or the money without doing the job. Now they say from that day where the advances have been paid to employee until today, the closing day where we have to close the books, 80% of that $2,000 is earned. Earned by whom? By the employees, which means the job is performed, or 80% of that job for which they have been paid $2,000 in advance is done. Now the question is, this is the process to account for, let's take it here in note, the process to record an adjusting entry. First step, I am going to call it step 0, and you understand why 0, because simply if the answer is no, there won't be any process. We stop it. Simply ask yourself, is an adjusting required? Okay. Translation of that question, what happens if we do not make any adjustment? Translation is, if we don't adjust, is there something wrong? So, if no adjustment made, is there anything wrong? Okay? To determine if there is anything wrong, this is what I really recommend to my student. This is not the standard, not accounting rules. It is just from pedagogical perspective, a recommendation I do that usually helps students to understand the system very well. So, as we said, it is based on a periodicity, which means the life of the company is divided into period, right? Period 0, period 1, 2, and at the end of every period, there is a closing, right? Closing of period 0, closing of period 1, closing of period 2, and that closing means, among other things, we have to prepare and publish the financial statement, and among the financial statement, the income statement. Okay? Income statement. Adjusting entries are about income statement, not about other. It means about the income statement. And what are the income statement? What is the last row, the last line of the income statement? The net income. And we said that the net income is a measurement, is a tool that measures the performance of the executive team. We say this many times, keep this in mind. The net income, that is how the bonus for the executive teams is calculated. Executive teams are going to get a bonus for their work calculated based on that net income. And the more the net income is high, the more the bonus is going to be high. So to make it easy, to make it really concrete and not an abstraction, make this assumption, it will help you. Presume that as if period 1 the company was managed by an executive team, 0, which is different from the executive team that managed the company on period 1, different from, which means presume that every accounting period the company was managed by a different team. And every executive team are going to make a claim. This revenue is for us. We earned this revenue. Don't put this expense on our shoulder. We did not incur this expense. That's not for us. That's for the other team. When you imagine this conversation, this negotiation, this discussion between the teams, it will make it much really easy and to understand. For example, so to answer the question, if no adjustment made, is anything wrong? Which means, are there any undeserved or non-deserved award to the current executive team if we don't adjust, or any punishment if we do not adjust. And we said the executive team are paid based on the bonus. The bonus is paid based on the net income. What does it mean, punishment or award? What an award would be for executive team? Recognizing a revenue, because recognizing a revenue will increase the net income and will increase the bonus. What a punishment would be? Recognizing an expense. When you recognize an expense, it decrease the net income and will decrease the bonus, and it will be a punishment for the executive team. You see how concrete it becomes instead of just simply theory. So I have to ask myself, if I don't make any adjustment, is there anything wrong? Which means, am I, for example, rewarding the executive for an non-deserved reward, for example, or punishing them with unfair expense, right? Am I awarding them with a non-deserved, let's say, revenue? Or am I punishing them with an unfair expense which they should not incur? Get back to our example. Now, ask this question here. The employees that have received that advance payment have now accomplished the work, or 80% of the job is now done. Okay? Now the question is, if I do not make any adjustment, am I giving a favor, a non-deserved favor to the executive team, or am I punishing them, or is it okay? Neither punished nor awarded. If the question is, the answer is neither punished nor awarded, then the consequence is no adjustment until two. Think about it. The day we paid this advance, was there any revenue or expense that was recorded on that day? When the advance was done to the employees, and we recognize it in the current journal entry, any expense or
Salary expense.
it was an advance. You recognize the salary expense if the job is done. The job is not yet done. At the time we paid that, we credited cash and we debited that account. Means the advance to employees, the account which you see here, which is an asset account. Advance to employees, which is an asset account. At the day the payment was done, we credited cash and we debited an asset, which is advance to employees, which means no expense have never been recognized so far with regard to this. Now they have performed 80% of the job. Now, if I don't make any journal entry adjustment, what happened is that the executive team has already taken advantage of that job. They consumed their job, but that they have never been charged for it. They have never been charged for the job that was done. And but they consumed the job, so which is unfair. They have to be charged for it. So the answer is yes, a journal entry is needed here, an adjustment entry is needed. Otherwise, the executive team that uses that job done by these employees have never been charged. One might say, okay, but we paid. Okay, no matter. It is not about payment. It is not about payment or receiving. It is not about cash. It is about revenues and expenses. Is there any expense that was recognized that they pay? The answer is no, which means they have never been charged for it, and that is unfair. They have to be charged for it. So then the answer is yes, we need an adjustment entry. If the answer is yes, of course, if no, no, no. If no, then no adjustment entry required. If yes, then go to the next steps. Step 1 would be very simple one. This is the easiest step. If an adjustment is required, is it about a revenue or an expense? Okay. Is the adjustment about a revenue or an expense? It cannot be about an asset. It cannot be about a liability. It cannot be about another equity item. Either a revenue or expense. Again, adjustment is about the net income. Adjustment entries is about to have a good measurement of the net income. And when we say net income, then it means expenses and revenues. So there, you cannot say I need to make an adjustment entry, but it involves assets and liability. No, it doesn't work. Yeah, there should be an expense or. So in our case here, we are talking about what? The employee, the advanced employee. This is about what? We get back to our case. So is it about an expense or about a revenue? %, of the wages that have been paid were earned. Is this an expense or a revenue?
The initial advance, expense, and then the part.
Okay, I knew this would come. It is earned by the employees. The word earned here, earned by the employees. We are not the accountant of the employees. We are the accountant of the company. For the company, it is about the salary. It is about an expense. The company doesn't earn anything when this job is done. The employees earn. But don't keep in mind, you are always the accountant of the company, not the other stakeholder. Every transaction, it involves two or many stakeholders. Keep this in mind. So you are the accountant of the company. So these salaries are not earned by the company. For the company, it is an expense, and it will. So it is about. The answer is it is about an expense, not about a revenue. Okay. This is step 1. Step 2. What happens to that expense? What happened to that expense? Increased or decreased? So, does the revenue or expense in question, or has it, or should, to adjust, should the revenue or the expense in question be increased or decreased? What is the answer for our case? We need to charge the executive for the work that was done, which means the expense has to, the expense for the company has to, we need to charge them for the job that they consume. So the expense has to increase. That increases. Increase an expense means debit or credit. Debit. So next step, apply the debit credit rules based on the decrease or increase of the expense or the. So now apply the debit credit rules to that account. Okay, so let's do it. Let's do it. So here we said this is about a salary expense, and it is about charging the executive team for a salary expense that they have consumed. And the salary expense is an expense, and we need to increase it, so debit salary expense. Okay? Debit salary expense. Okay, we're going to calculate the amount later. For now, we need to know what to credit. Okay, what should I credit? So next step 4, is to identify the asset or liability account related to the adjustment. Identify the asset or liability account affected by the adjustment. And it can only be an asset or liability account. It cannot be another expense account. It cannot be another revenue account. It cannot be retained earnings. It cannot be any equity account. It's only adjustment will only affect from one side an expense or a revenue, and from the other side an asset or a liability. That's it. You don't have an unlimited choices. You have just two, either an asset or a liability. Here, I can get back, try to identify, and then when you get familiarized with the process, this will remain, step 4 will remain the most difficult step. All the others you will get it will become very easy with practice. This one, it will remain a little bit confusing. So, salary expense, I know I have to debit the salary expense for sure. I know that the other account has to be credited. And I know that that other account should be either an asset or a liability. Let's make what are the possibilities here? Could it be an asset? Okay. If I put an asset on the credit side, it means decrease of an asset. Is there an asset that decreases when I recognize this salary? Okay, let's start with the liability. If I put a liability on credit, what do you mean? It means an increase of the liability, right? Credit side. Are there any new debt that raise from the fact that the job was done? No, doesn't make sense. We have already paid already. It was paid in advance. There's no debt. Payment was made in advance. There's no cash to pay. So immediately, automatically, we exclude the liability option. So we only have an asset. What kind of asset could have been decreased subsequent to this job which is completed? If I look to my assets here, which one needs to decrease once the job is done? The advance payment, because it is no longer an advance. It was called advance because it was paid before the job is done. Now that the job is done, there is no advance anymore. It is no advance, right? So the asset that needs to decrease is that asset, advance. It won't decrease 100% of it. They say not the full work was done. It will decrease to the range of 80%. So then, so in this case, in our case, the asset to be credited is simply the same which we have here in the trial balance, advanced employees. And then next step, calculate. Sometimes calculation is, sometimes the number is given simply, no need to calculate. Calculate. So the dollar amount, if not given, sometimes it is given as is. Take it as is. Sometimes it needs calculation, like in this case. So here we need to calculate. They say 80%. 80% of what? 80% of the 2,000. So 2,000 multiplied by 80%. Same thing. And then, if not obvious, the last step, check the balance of the entry. make sure total debit equal total credit, which is the case. Now we are done. We can move to the next one. So it took a lot of time, as you can see. But however, the good news is the adjustment entries is not an infinite number of adjustment entries. There's a dozen or maybe around 20 journal entries from now to until your midterm with the correct assignment. You will do them. So then if you do a journal entry, it becomes, you don't need to go through all of this process. It just becomes a memorization effort. Just remember how we did this before and do it. As simple as this. But at least at the beginning, you have to make this exercise so that you master the. Let's do the second one. The second one, it says, okay, second journal entry. Just an entry if needed. We will see. Account of the supplies at the year end revealed that $600 were still on hand. We started what is in the unadjusted balance as supplied, the total amount in the unadjusted balance as supplies is $3,000. Where does it come from? $3,000 of supplies. When did we? How did we get to this number? As the company purchased supplies, they debit supplies, right? They may have made many purchases during the year, and as they purchase supplies, they credit cash and debit supplies, credit cash, debit supplies, credit cash, right? In May, in August, in July, until at the end of the year, they came to this number, $3,000. But now on December 31st, when you count the value of what remains from those supplies, we find that the value of what remains is at 600 only. What does it mean? What happens to the difference? Account of the supplies at the year end revealed that $600 of supplies were still on hand. There was 600 from the 3,000. There was 600 still on hand. What happened to the difference? What was? These are supplies. They were purchased to be used, not purchased to be kept, right? So it simply means they were consumed. The difference is the supplies, those paper sheets that were used for printing, those staples that were used, those supplies that were consumed, right? So if we have made a total of $3,000 of supplies, and at the closing day we find that we only have on hand 600, it means that there is $2,400 of supplies that were consumed during the period. Okay. Question now: is this a situation that requires an adjustment entry? Yes or no? The sub question of this: is there something wrong if we don't do any adjustment entry? Sub question of this: are there any punishment or an non-deserved hour granted to the executive team if we don't do any journal entry? What do you think? If we don't make any adjustment, the current executive team that run the company during that period and that consumed those supplies, are they punished or awarded? If we don't do, punished? Why? They have consumed the supplies.
Oh.
But so far there is no expense at all charged to them. They are actually they are given a favor, a non-deserved favor, because they have consumed supplies for which they have never been charged. Okay? No one may say, and this comes out with this question, yeah, but they paid for it. They paid the $3,000. It is not about payment. It is the payment is the misleading criteria. Don't think connect adjustment entries with payment at all, or collecting cash or paying cash. Even though they have paid for that supplies, but it has never been recognized as an expense so far. As they buy supplies, as they purchase, we debit an asset, debit supplies, inventory, credit, cash. So there is no, they have never been charged for it. Now it is time to charge them. They have consumed those supplies and they need to be charged for it. To be fair, so the answer is yes, an adjustment entry is needed, because if we don't do it, the current executive team are having a non-deserved advantage or favor, and they have to be charged for it. Decision is done, the adjustment entry is needed. Next step, is it about an expense or a revenue? Expense. You need to charge them for the consumption of supplies. Do we need to charge or reduce or increase or decrease the expense? We need to charge them, which means increase the expense. Increase an expense means have to debit or credit. To increase an expense, do you need to debit or credit expense? Debit, right? The expenses always increase on debit side, increase on credit side. So we have to debit an expense. What is the expansion question? If you look at the list of expenses in this company, what are we talking about? So it is, I don't see it here. If it is not there, which means it has never been recognized before, that's why. So what is an expense? So it is simply the use of supplies. The consumption of supplies. So, consumed supplies. You can also use, if you don't need to create a new account, you can use the one of the existing. The closest one is miscellaneous expenses if you need. But I can create also a specific account for these consumed supplies. That is the debit account. What should we credit now? So we say any adjustment entry. From one side, for sure, it involves an expense or a revenue. Now this is fixed. We know it is an expense. And without expense should be the debit side. I have to put something on the credit side. And we said any adjustment entry will only, from the other side, include an asset or a liability, which means you cannot adjust with another expense account or with a revenue account, with an equity account. It should be an asset or a liability. So, okay, let's start. What could it be? A liability. If I credit a liability, which means as if I had a new debt. The supplies have already been purchased before. Is there any debt? No. But something, an asset will decrease when you consume supplies. What asset decreases when you consume the supplies? Supplies makes sense, right? Common sense, okay? Supplies will decrease when you consume supplies. Supplies is an asset, so that asset will decrease, which means that's what you need to credit. That's what you need to credit as an asset. Is there any calculation required? Yes, calculation is required. The amount is not given directly because they say we count $600. Is the journal entry 600 here? Is the amount should be 600 here, or $600 is the amount of the supplies that remain on hand at the end of the year. But we need to account for the supplies that were consumed, not the remaining. So the consumption is the 3,000 minus 600. The consumption is we have consumed from the original $3,000 we have accumulated here on supplies. From that amount, we only have 600 remaining, so we consume the difference, minus 600. Okay. Next. depreciation was $1,000. Depreciation of the equipment. And what does it mean? Anyone explain what depreciation means in this context? Depreciation of equipment? Yeah.
Gradually losing value.
After one additional year of use of the equipment, the value of the equipment will decrease. After one additional month of use of your car, the value of your car decreases. After one additional year of living in your home, the value of your home will decrease, right? So that is the depreciation. The depreciation is the decrease of the value of an equipment or a capital asset subsequent to an additional period. So they have made the calculation for us, and they say the equipment has, the depreciation of the equipment was equal to $1,000, which means subsequent to this additional year of use, which was done by the executive team. So the executive team have consumed $1,000 of the value of the equipment. If we don't do an adjustment, are we giving them a favor or a punishment? If we do not adjust, the executive teams have consumed $1,000 of the value of the equipment because of the use of the equipment to generate revenue. And we never received any invoice for that, any external bill, nothing has been recognized so far. So if we don't do anything, are we fair towards no, there's something wrong. They have to be charged for it, right? Because they have consumed this equipment, and so far, we are giving them a favor, non-deserved favor, because they have consumed the equipment without never been charged for them. So the answer is yes. Justin Hunty is me. Okay. Next question: is it about an expense or a revenue? Yearly expense. Which expense? Depreciation expense. Okay. Should I increase the expenses or decrease them subsequent to this? Increase them. An expense increases on which side? Expense increases on the debit side. Okay? So I have to debit depreciation expense. Okay? Debit depreciation expense. What should I credit? So when it comes to depreciation, for now we are going to have a full topic about it.
I was gonna say, so you credit
Equipment.
yeah.
Okay, very good point. Thank you for the gift. It makes sense to think about equipment. Okay, where is the pen? So it makes sense. I have equipment. Original cost, let's say $20,000, and then that equipment is subject to depreciation. It lost $1,000. Okay. So its value is $19,000. Okay. You are correct. However, from a accounting perspective, if we do this, if we debit depreciation expense and credit equipment, what happened? The balance sheet will show the net amount of the equipment, the net book value of the equipment only. We don't need that. We need to keep the standard sector require that you keep the original cost. You have to keep every time showing the original cost. We need to keep the 20,000 as is shown, and then use another account, a counter asset account, to account for those accumulated depreciation. That's why we need another account, which is accumulated depreciation, to account for that depreciation. Why? Because even though what you did is theoretically correct, however, the requirement is that we continue to show the equipment as its original cost, and any depreciation should be accumulated in a separate account, which is called accumulated, so that a user can see both. They can know how much was the equipment when we bought it 20 years ago, and how much is it worth today. For that reason, we do not credit equipment or the PPE itself. we credit accumulated depreciation, which will be subtracted from the equipment so that we get to the result you are talking about. Okay? And again, we will have a full topic about this, about depreciation. So the account here is accumulated depreciation. Of the equipment. And the amount is given to us, no need to calculate it, no calculation to do, already given. Okay? Good. Next. Number 4. Okay. Number 4, it says the deferred revenue. Let me. The deferred revenue which one? We are talking about a deferred revenue which is exists here. I have here in our unadjusted trial balance an item which is called deferred revenue. Where is it? Deferred revenue. Here is it. Okay. So they say this $6,000 of deferred revenue. It has a story. What is the story? The deferred revenue was an advance receipt for future deliveries of goods. By December 31st, 2/3 of these deliveries have been made. Okay. Question: in this case, is there an adjustment entry required? Needed, yes or no? Which means if we don't do anything, so you understand the story, and the story is the $6,000 you see here in in an unadjusted balance, which is called deferred revenue. Where does it come from? It comes from an advance that was made by our customer. We received the cash, $6,000. At that time, none of the goods were delivered. But this happens maybe in August, maybe in May. We are now in December. When we come to December, 2/3 of the $6,000, 2/3 of the goods that are concerned with $6,000 are now delivered, right? And so far, there is no revenue recognized at all so far, because the day we collected the money, we did not credit revenue. Debit cash, credit deferred revenue, which is a liability. Question is, what happens to the current executive team if we don't do anything? Are they awarded or punished if we do not do anything? If we close the books without making an adjustment, are the current executive teams awarded, or they are giving them a favor, non-deserved favor, or a punishment? Excellent. And this is not a very easy question, really. Why? Because most students will make this wrong thing, which is to say, since they have it is the team who collected the money, since they collected the $6,000, then they are awarded. Because students will continue to connect award and punishment to pay in cash and receive in cash. When you receive in cash, that is the award. When you pay cash, that is the punishment. You have to disconnect yourself from this approach. That is completely wrong. They received the cash, but they did not receive any award for it, because no earned revenue was recognized for them so far. There is no earning revenue which is recognized for them while they have earned the revenue. Since they have delivered 2/3 of these goods, then they deserve to recognize, to have the award of recognizing the 2/3 of that delivery. So yeah, they are punished, and then we have not to adjust. Now, the adjustment is, next question is this an adjustment of an expense or an revenue? Obviously, we are talking about the revenue. Okay? Is this revenue, to make an adjustment, should it be granted or increase it or decrease it? Is it about recognizing the revenue or de-recognizing the revenue? Recognize the revenue, but has never been recognized. Where do you recognize the revenue? Debit side or credit side? Recognize the revenue. Credit side. Okay, so recognize an expense, debit side, recognize an asset, debit side, increase the liability, credit side, increase the revenue, credit side. So we have to credit sales revenue, okay? They have sales revenue here. Then we have to credit. We keep space for the debit. I don't know what will be in the debit for now. So for now we keep the space for the debit, and we jump to the credit and we say sales revenue. And then we start thinking about what should debit, what we should put on the debit side. Okay, again. It should be either an asset or a liability. An asset or a liability. Will it be an asset? So it is about a revenue which is now recognized, but we have collected the money in advance. The cash was collected in advance. Or is it a liability that we have to debit? That may put a liability on the debit side means decreasing. Is there a liability that decreases subsequent to this transaction? Look at the list of your liabilities. Do you see any liability that needs to decrease? This is the list of your liabilities. Liabilities are here, only two. We only have two. Is there a liability that needs to decrease? Obviously, the deferred revenue, because it is no longer deferred. It is earned now. We can't keep it as a deferred. We called it deferred at the beginning because we got the cash, we got the money, without delivering the goods. Now that part of the goods are delivered, so the portion of that related to the delivered goods is no longer deferred. It's no longer liability, so we have to decrease that liability and debit deferred revenue. Debit deferred revenue. And by the way, your deferred revenue. How much? Do we have to make a calculation? Yes, we need to make a calculation. They say 2/3. 2/3 of what? 2/3 of the 6,000, right? So that's 6,000 of deferred revenue multiplied by 2 divided by 3. And don't forget the deadline for your first assignment. It will be, I think, September 29. We are very close. If you don't do it, there's absolutely no chance to extend for the simple reason. It is not because I'm not tired. No, simply because on September 29, as soon as we get to the deadline, automatically the solution will be available. So if the solution is available for your colleagues, there's no way for me to get to an extension. Solution becomes available for people, so I cannot get it. So if you need to take advantage of the assignment, then do it, because your midterm is taken from there. Your midterm, your midterm is taken from the Connect assignment. Your midterm are questions taken from the Connect assignment. So familiarize yourself with assignment, and you will not be surprised with the midterm. You will see the same question, the same problem. I'm not talking all of them, of course. A selection is in such way that we cover. And I see all those who did the assignment, you get 95%, 96%. Most of you got more than 90%, right? Which means easy marks. Easy marks that could be really helpful. You don't know what's happening after. It could be, for now, they are not counted, but they might be counted if you need them. If you need them, they might be counted if you, for some reason, you fail an exam. At that time, they will save you. So it is up to you. You do them, you don't do them, but if you don't do them, there are two kind of losses. The first loss, you won't be ready appropriately for your exam. And your colleagues will have an advantage upon you, which is the fact that they know the question and they did it. And the second, if something goes wrong at the end and you need some supplemental marks or some makeup, you won't have that backup that will save you. So I really recommend very strongly that you do that. What else? So next. So please try to participate now. I think we start to familiarize now progressively. I know it is not easy. I know. I told you from the beginning. From the class introduction, if you remember, the most difficult aspect of this course is what we are doing now. All what that will come after from next week until the end is much easier than this. And we cannot do it otherwise. We cannot organize the course in a different way so that we keep the difficult. It doesn't work like this. We have to prepare the financial statement. You cannot prepare financial statement without doing adjustment entries, and then we can move forward with our accounts. So I know you are struggling. It is normal. I have even the same course at Ottawa University today, and they're struggling. Ottawa University for you, same thing. Because we are moving through the most complex aspect of financial accounting. If you take even your attention and you try to understand and follow me and follow the reasoning, then you won the course until forever. Means until the end of the course, all the remaining aspects and topics will really be easier. But unfortunately, if it doesn't work, and if you finish the 2 weeks of adjustment entry and still don't understand, you will continue to struggle. And you have to, I have already the recording of the class meeting will be available for you. Then you have to see again the recording and make your practice. Is it time for a break? Yeah, it's time for a break. Let's take a look to the trial balance. On the trial balance, as an adjusted one, we see that there is a bank loan of $20,000. Okay, and what they say now, payable of course. They say the bank loan was a 6-month loan taken on October 1st, 2024. So where we are in December 31st, 2024, right? On October 1st, which means 3 months ago, right? October, November, December, 3 months ago, we took that loan of $20,000. Okay, and there is an interest rate of 9%, and the interest is going to be paid on April next year, 2024. Okay, what do you think about this? Always the starting point. Do I really have something to adjust? Which means, if we don't do anything, is it fair or unfair, or is it a favor, or is it a punishment to existing It is about a loan. We received it on October 1st, and the loan is a rent of money. We rented the money starting October 1st, and there are interest running at the rate of 9%. And we are going to pay the interest not now, on April next year. So one might say, okay, let us pay and then we'll see. Why we have to do something now? We have to do something now, because if we don't do, would it be a favor, an undeserved favor, or a punishment to the existing executive team?
Because it's going to be an interest paid back for the next executive team, even though the loan was taken on this year.
Which means the team of this year are getting a favor or a punishment?
If it's not like adjusted.
If it's not adjusted, it is a punishment. We are punishing them. How?
So it would be recognized for the next.
Talk about the current team. The current team, they have consumed interest, right? They they have start using the money and they consume the interest. And if you say punished, means if they are punished, means that there is an expense that was recorded for them. Which one?
It's not a loan that
The loan is the principal. $20,000 is the principal, the liability. Expense is going to be more in addition to reimbursing the principal. They will have to pay an extra amount for the extra. We are talking about that extra amount, about the interest. So if you don't do anything, the executive team have consumed the interest,
so, yeah.
but they has never been charged for it. So they have been granted a favor which is not deserved, and it's not fair. And it's especially not fair for the next team, because they will pay them for 6 months while they only use 3 only. Okay, good. So a journal entry is needed. Okay. Is it about an expense or a revenue? Are we talking about an expense or a revenue? Expense, interest expense. Because this is a loan payable. Okay, there is an expense involved. Now, should we recognize or de-recognize the expense? You have to, in order to adjust, in order to make the adjustment. Is it about recognizing an expense or de-recognizing, removing the expense? The expense in question is the interest expense. Okay, you borrow money, you have to pay the extra amount, which is interest. So, and is this an expense or a revenue? It is an expense, obviously. Okay, and the expense it need to be recognized. So we have to increase, we have to charge the company, the executive team for this expense, which means we have to debit or credit the expense.
Yeah.
Debit. The expense increase on the debit side. So we have to increase expense, so we have to debit interest expense, okay? Debit interest expense. And credit something. What is that something? It should be either an asset that decreases on the credit side or a liability. And since it is a credit side, it will increase. So it is about a liability that increases. Do you see any asset that decreases because we have to pay an interest? I don't see any asset that decreases because we have to pay. But the fact that we have to pay interest, that is clearly a liability. So there is a liability that needs to be credited. What is that liability? Interest payable. That's simply interest payable. So we have interest expense, and interest payable is the liability, the amount of interest that is going to be paid on April. So interest payable. Is there a calculation to do? Yes, there is a calculation to do. 9%. So to calculate the interest, always the rule for calculation of interest is always the same. So interest equal principal times the rate, interest rate, times the period of time. Principal, in this case, how much? $20,000. Times the rate, 9%, times the time. 9% is for a full year. 9% is for 12 months. Are we going to recognize an interest expense for 12 months? No, only for 3, right? October, November, December. So 3 out of 12, that is the portion of time, multiplied by 3 months out of 12. Why 12? Because the 9% is for a full year. Why 3? Because it is about October until December, as per the data we have. Because it is, the bank loan was 6 months taken on October 1st, and the interest rate is 9%, and the interest is not due to be paid until April 1st, okay? So now, there is some confusion, some students do sometimes. They might think this which is wrong. They might say, okay, the loan, the full period of loan is 6 months. So the 9% would be for 6 months. No, by convention, whenever you have an interest rate, it is always for a full year by default. Interest rate, if given to you, always consider it for the full year, unless otherwise stated, unless they tell you the interest is 1% per month. In that case, but if anybody in our financial accounting courses, all problems, if they only give the rate without any specification to the period, by default, interest rate is always for a full year, 12 months. Okay, no matter how much is the loan itself. So the 9% is relevant to 12 months, but we are not going to recognize 12 months of interest expense, just December, October 1st until December. Okay. So calculation then it would be that principal which is in the trial balance $20,000 multiplied by 9%. 9% multiplied by 3 out of 12. $450. Okay. Next, number 6. It says, please